Good. So now, if you look at this particular topic under margin and absorption costing, it is the simplest topic of all because you only need to understand how you are going to deal with one particular item. That is fixed production overheads. Once you've been able to understand how you're going to treat these fixed production overheads, then automatically you are done with this particular topic. Because the examiner will be asking you very simple questions. One, can you give us the arguments against marginal and absorption costing? Give us the arguments against. Give us the arguments that are supporting this. That is arguments for marginal and absorption costing. Give us the applications, some of the applications of marginal and absorption costing. That's number two. Number three, if you now go to the calculation part, having done the theory for this particular topic or margin and absorption costing, are you able to give us the income statement? Are you able to give us the income statement with respect to marginal costing? Marginal costing, income statement. Are you able to give us absorption costing, income statement? Are you able to give us the two? And of course, due to the difference in method or the procedure of getting the net profit, this one here will bring a very huge difference or effect to the net profit of marginal costing and also the net profit of absorption costing. How we are going to deal with this one here in these two methods will determine the amount of net profit that you're going to get as per this, and also the net profit you're going to get as per absorption costing. And therefore, because the profits are going to be different, yet the same data set is what you're going to use, you must be able now to go ahead and give us reconciliation statement that is going to help you to reconcile the different profits as per marginal and the profits as per absorption costing. So you must be able to come up with the reconciliation statement. You must be able to prepare the income statement as per absorption and marginal costing. Then in the process of preparing the statements, we are going to meet these terms: absorbed, the overheads. You are going to absorbed overheads. There are those overheads. Under absorbed overheads, you're going to meet under absorption or over absorption. You're going to meet the different values of the closing inventory. For example, under this, you're going to find that the closing inventory in terms of units will be 150. But now the value of the closing inventory will be different for each method. And therefore, for the closing inventory, during reconciliation, you are also going to meet these terms of understated, stroke overstated, stroke overstated, one, closing inventory, and then opening inventory. We all know that the closing inventory of the previous period is the opening inventory of the current period. So in short, if you're going to deal with the two different periods, let's say the month of January, month of February, when you have opening inventory here, you will have it, then closing inventory. So if the closing inventory in the month of January happens to be 80, it will be the opening inventory in the month of February. So we have closing inventory affecting the transactions in January as a closing inventory. We have the same closing inventory going to affect transactions in the month of February as an opening inventory. And therefore, the effect of these two items, even though it might be looking like the same thing, but how we use it here, we call it closing inventory. When we now move to the next or the subsequent period, we call it opening inventory, and they have different effects on the cost of sales. So because they have different effects on cost of sales, we are automatically going to see their effect on our net profit at the end of the day. Again, this one here, or this concept, is an extension of the last part of topic number 4, which we covered, where we're dealing with over stroke under absorption. That concept has been transferred to this particular topic, but then you're going to look at it when we are dealing with the fixed production overheads. Under reconciliation, we must know the overstated or understated value of the closing and opening inventory. That is what we basically need to understand here. So let's get to our LMS where we have the notes from this particular topic. Then we should be able to see what is going on there. What do we need to know in terms of theory? What do we need to know in terms of theory? So let's get to the platform. Let's get to the platform. I've logged into the platform. So let me get to my courses. Let me get to my courses under management accounting. We need to move direct to topic number 5, number 7, topic number 7. And the first part of topic number 7 is the differences between marginal. So marginal and absorption costing are two different approaches to dealing with fixed production overheads, and whether or not they are included in valuation or valuing inventory. So the reason why they are going to have different prices is basically due to the effect of how we use the fixed production overheads in our transactions. Now, if you look at these, the distinction, the difference between the two, one, if you're going to compare them based on meaning, a decision, so marginal costing, a decision-making technique for ascertaining the total cost of production, then absorption costing, apportionment of total cost to the cost center in order to determine the total cost of production. Now, this is what we need to understand. This is what we need to understand. If you look at marginal and absorption costing, I think just some minutes ago in your WhatsApp group, I indicated that we are going to do topic number 7, and I mentioned variable costing and full costing. When we arrive in class now, we are talking about marginal and absorption. When you're going to do your cut or mock, you'll be finding that I'm going to indicate direct, then indirect. So the examiner can use any of these three to refer to marginal costing. The examiner can use any of these three to refer to absorption costing. How do we get the cost of the products under marginal? Marginal costing, remember what we said the other day, that for us to get the cost of a given product, we are going to have direct material. We need direct labor plus any other direct cost for us to arrive at what we call prime cost. When we add, now as per this particular method, marginal costing, remember here we are adding production overheads. If you can remember what we covered the other day, we are adding production overheads. Here, we now have to identify or classify the production overheads into two. Remember, we have the variable production overheads, and then we have the fixed production overheads. As per marginal costing system, it is only variable production overheads that forms part of the product cost. And therefore, if you now get to this part, we have to be specific. We have to indicate variable production overheads so that we get product cost. When we come to absorption, full costing or indirect method, here we have to get to the prime cost, so direct material, direct labor, then we have our prime cost. Then we have to add variable production overheads. Then we have to add fixed production overheads. When you add these, you are getting product cost or production cost. That is the difference between these two methods. That is the difference between these two methods. Now, from whatever you've just seen, from the formula that you've just seen, you'll be able to see under full costing method, we are including the fixed cost to be part of the product cost. So automatically, this cost will be higher than this one here. When the production cost is higher on the full costing method as compared to this side, you'll be able to see that net profit here will be higher as compared to the net profit this other side. So we expect that, remember, you're going to use the same data. If production is 7,000 units in the month of January, it is the same across. But at the end of it, you're getting the profits to be different. So you have to reconcile the profit so that the profit here is equivalent to the profit on the other side. That is what we have. That is the structural definition or classification of what we are going to discuss. So now look at what we are being told here. Look at what we are being told here. So cost recognition, the variable cost is considered as product cost, while fixed cost is considered as period costs. Both fixed cost and variable cost is considered as production cost. But remember, it is not just any other fixed cost. It is fixed production costs, fixed production overheads. Classification of overheads, we have fixed and variable, while absorption, we have production, administration, selling, and distribution. That is under absorption costing, we only know production costs and non-production costs, where the non-production costs are classified into administrative, Then we have selling and distribution costs. Profitability. Profitability is measured by profit volume ratio due to then this other side, due to the inclusion of fixed cost, profitability gets affected. Profitability gets affected. So that is, under marginal costing, the profitability is constant. The profitability or the profit, the way of getting the profit is constant, and the only way, the simplest way to recognize your profit will be basically dependent on volume. Volume of output. Volume of output. If you are keen enough with what we've been discussing in the previous period, it is only volume of output that's going to affect this particular results. So it means this one here is taking you to already applications of topic number 7, or basically marginal costing. Initially, the topic of marginal costing was combining limiting factor, was combining break-even point analysis. So that is, if you are now able to understand just marginal costing itself, it means if we get to topic number 8, where we are going to discuss break-even point analysis, you will be good to go. Because under break-even point analysis, you're going to find that one of the assumptions is that the volume or the profit of a company or sales are dependent on the volume. As the volume increases, the profit increases. And that's why you normally find that in topic number 8, under break-even point analysis, we also just deal with the 2 types of costs. It is either variable or fixed. So the variable costs will be grouped together for you to come up with the break-even point function. This one here, that is the break-even point. So as you can see, it is selling price minus variable cost or the contribution margin. So the changes in this is basically dependent on the Q or quantity of output. That is what you are going to cover. So basically, if you are asked to give maybe 3 or 2 applications of marginal costing, number 1 is used in break-even point analysis to identify the break-even point at which the company will not be making losses or profits. Another application, there are these things that the company is trying to produce. So 1, they are producing 3 products, C, X, Z. But out of these 3, this one here, they are making, if you look at the net profit, this one here is a negative. So they want to come up with a decision, or they want to do investigation to determine whether they can eliminate this product. That decision is arrived at by applying the marginal costing concept. You look at the variable components, which automatically will be depending on the units of output. Having done that, how will elimination of this product affect the distribution of fixed cost, which is shared by the 3 products? That's an application of marginal costing. There's this company that also has a decision whether they are not able to determine whether to buy / make. They are stuck in between buying or making. So of course, if they're going to buy, they're going to outsource. If you're going to outsource these goods, there are some costs that you cannot avoid. 1, if you decide to buy, you're going to incur the transportation cost. You bring them to warehouse. So the storage cost within the warehouse, you have to pay that. Whether you are going to make your own product or you are going to outsource. So in making this decision, they have to determine how much are they paying for the storage? How much are they paying for the warehouse? If they eliminate one product and they decided to buy it, will it help them reduce the effect of the fixed cost to other products? If they decide to manufacture it, will it be economical to manufacture that particular product, taking in mind the quantity or the level of demand of that particular product? That's another extension or application of marginal costing. The limiting factor effect, the limiting factor effect. A company is producing these three products, but raw materials Z, or let's say Q, is being used to produce the three products. And in one particular year, the company is only able to do what? The company is only able to purchase 4 million units of this raw material Q. How will they ration the available units of material Q to produce C, X, and Z such that they are able to meet the market demand, and at the same time, they maximize their returns or their net profit from that particular raw material Q? That particular knowledge must just be understood by, first of all, ensuring that you understand what marginal costing entails. Are we together? Are we getting sense? Are we really getting something from that? Are we getting something from that? Are we getting something from that? Okay, then you now come to this part here, cost per unit. Here, stock does not influence the cost per unit of output, that is marginal. Then here, variances in the opening and closing stock affects the cost per unit. The variances here in the opening and closing stock occurs due to the differences in the absorption rate. We have over and under absorption. Then highlights contribution per unit. We are going to deal with the contribution per unit here, that is gross and net, while absorption costing, we are going to deal with unadjusted profit, and then finally look at the adjusted profit. So valuation of products under marginal and absorption costing. And under marginal, of course, I've just mentioned it here. We have direct material, direct labor, then variable production overheads. Under absorption costing, we have direct material, direct labor to give us prime cost. Then we add variable production overheads and fixed production overheads. So the two forms part of the product cost under absorption. Comparative income statements. Under marginal, this is what we are going to have. You need to have sales. Then when you're going to less the cost of sales, we have opening stock, add production cost, where the production cost consists of material, direct labor, and variable production overhead. So having added the two, you multiply by the units that were produced. Then you're going to get what we call gross contribution with less other variable costs. When you less other variable cost or non-production variable cost, you'll arrive at what you call net contribution. Once you get your net contribution, the first thing you less fixed production costs, then fixed non-production cost for you to be able to arrive at your net profit. How about absorption? The sales value will be the same, less cost of sales, where we have opening stock, add production cost, which now entails direct material, direct labor, production overheads, that is variable and fixed. Then we less closing stock for us to get gross profit. But the gross profit you are getting here, first of all, you get the unadjusted. You adjust it by looking at over or under absorption of overheads. Then you get to the deduction of the fixed non-production costs. And of course, you have an illustration here, which we are not going to tackle because some will not be able to get it. I want us to pick a question from the past papers. But you can attempt this. You try doing this, you discuss it amongst yourselves. If not, it might find itself in your CAT or mock. That is for the ATD students and even the CPA. Having done that, it is taking you basically to the arguments. So arguments for the use of marginal costing. Arguments for the use of marginal costing is basically advantages. So how is using marginal costing advantageous or beneficial to an organization? So one, you can see it helps in decision making. That is, marginal costing is useful in short-term decision making, such as price determination. We've seen it here. We've clearly seen it here when we were saying the applications. Those applications are now some of the benefits or arguments for. So we've seen if you want to do production of a given product, it enables you to determine the quantity you are going to produce. And in the process, by predetermining the price, you can be able to make the decision on what profit margin or markup to set for your goods. Number two, under break-even point application, we are able to see it automatically enables you to know, one, the units you are supposed to produce for you not to make any loss. That's number one. Within the same place, remember, under break-even point, you can have a target profit. If you have a target profit, how can you use the target profit to work backwards to know the exact units you are supposed to produce? Still an application of marginal costing. Still an application, and that's one of the arguments for marginal costing. Then number three, we've been able to see you have to make a decision here whether to buy or produce. Whether the quantity you are supposed to produce, even what you're supposed to purchase. The limiting factor. You have limited resources. How will you distribute it? How will you distribute the limited resources? Again, an application of marginal costing. And that one automatically confirms that the arguments, or it gives us the points to indicate under arguments for marginal costing. Let's see another one here. Then we have easy to understand. Marginal costing is simple and easy to understand. Of course, we've been able to see that. The only thing you need to know is to identify the variable production costs. Then now arguments against, or some of the limitations in accurate profit calculation. Why? Marginal costing does not take into account fixed overhead costs. As a result, it may provide an inaccurate picture of the profitability of a product or service. Then, inadequate for long-term decision-making, marginal costing focuses primarily on short-term decision-making and may not provide a comprehensive view of the long-term profitability of a product or project. Undermines cost control. Marginal costing does not emphasize cost control or cost reduction efforts. You are trying to minimize cost, but so long as you have the variable production cost, it considers only volume. It is only concentrating on the volume of output. It does not work towards minimizing the existing variable costs. Then distorted inventory valuation, which we are going to see after doing an illustration. Ignoring capacity utilization. It does not consider whether the company has got excess capacity, which can be used in other activities. It is basically considering that basic or. So here they are trying to explain that marginal costing assumes that fixed costs remain constant within a certain production capacity. However, in reality, as production levels changes, fixed cost may also vary. Ignoring capacity utilization can lead to suboptimal decision regarding pricing, production levels, and resource allocation. How do we really look at this? How do we really look at this? For example, one, the company, so the fixed production overheads, we have 4,000. We have 4,000 units produced. We have 100. So you can see, if the company is going to produce only 100 units, then the fixed production overheads per unit will be, the fixed production overhead per unit will be 4,000 divided by 100, which is 40. When these units are now increased by just one, that is 101, what will be the new fixed production overhead per unit? We are going to have 4,000 still, but now you divide by 101. What will we have? What will we have there? What will we have there? Somebody? 4,000 divided by 101. 39.6. It has now reduced from 40 shillings to 39.6. Let's say the company has tried so hard to increase this to 105 units. They have increased the quantity to 105 units. What will be the new fixed cost per unit? The fixed production overhead per unit, what will we have? 38.1. So you can see, as the quantity increases, the fixed production overhead per unit is reducing. The company is able to recover the fixed production overheads that were incurred. So this one here, imagine under marginal costing, it says that the fixed overheads are constant. It does not change. Even if you produce 500 units, it will still be this one here. But now, under absorption costing, you'll be able to see that the fixed production overheads must be used in consideration of what was actually produced. You give us the standard, yes, but we compare the actual overhead as per your standard. Then we now look at over or under absorption. That is what we need to understand here. So as the quantity increases, from 100 to 105, the fixed production overhead per unit is reducing. And the reduction in that is basically beneficial to the company because it is helping them to increase their final profit. Then if you move forward, so those are some of the arguments for and against marginal. Then we have arguments for the use of absorption costing. One, conforms to generally accepted accounting principles. Then useful for long-term planning. Then number 3, useful for inventory valuation, useful for setting prices. Automatically, it confirms to us that currently those companies that are reporting their performance, the financial statements, those companies that are publishing their financial statements, a manufacturing company or a company that's offering service and they are doing costing, they don't use marginal. Marginal costing system is used by basically management. It is being used when preparing management report. But we are going to prepare published financial statements. You basically use full or indirect or absorption costing. That's what you use to report your financial or to publish the financial statements. If you're going to do valuation of inventory, the correct one that is normally being used when publishing financial statements is the full costing method, not marginal. Marginal is basically used for internal consumption by the company. The marginal method is basically used by consumption by the internal management of an organization. So that is what we have there as arguments for. Then if you move further to this part here, so the reconciliation, of course, you're going to look at it. There's a question, and then you are required to come up with the income statement under the two methods. Then you do reconciliation. So what you also need to understand, if you look at the cost outline, let me see if I can get it. Yes, it is here. If you look at our cost outline in topic number 7, look at what the examiner wants you to know. But they are very funny. In topic number 7.1, you should be able to understand the differences between marginal and absorption costing, which we've done. Comparative income statements, which we are going to prepare, but we've compared the differences and within the comparative income statement components as we do a practical question. Here in the course outline, let's be clear on this. 7.3, you are being told to give us, to do what? To give us arguments for the use of marginal costing. Then arguments for the use of absorption costing. But if you go to, is it April 2023, you'll find that the examiner is telling you to give 4 disadvantages or arguments against marginal costing. When you come to your course outline, it is not there. We only have arguments for the use or the benefits of using marginal costing. But now if you get to the question, they are telling you to give the disadvantages, limitations, or arguments against the use of marginal costing. In some cases, they will tell you, can you outline 4 limitations of marginal costing that may make someone to shift from using marginal costing to using absorption costing? Then you are being given free 8 marks there. You are being told to highlight the limitations of marginal costing that may lead to someone shifting from marginal to absorption costing system. So you can do a research on that. You can look at the limitations. You can look at the arguments against, but within the course outline, this is what is here. But CASNEB normally said some things outside the framework which they have given. So like limitation is not appearing here, but you may find that in your exams, you'll be asked to give at least 4 limitations of marginal costing. So that is it. If you get to the same topic number 7, if you cannot go through these notes, you can also get the other notes here, which I believe are almost related. So you just get to this part here. Just get to that part there, where I will be sharing my screen with you. So if you look at this one also, it is almost the same as what we have there. You are being told to give the differences between marginal and absorption costing. Those are the differences that we have there based on definition, contribution margin, inventory valuation, comparative income statements in marginal, the structure, the components, all these stories are there. Arguments for the use of absorption costing, we have them there. application of marginal costing. 1, pricing decisions, make or buy decisions, production mix decision, that is topic number 8. Then sales volume analysis, that is break-even point, still number 8. Budgeting and forecasting, short-term decision making, that is for marginal, which we've been able to actually explain. So that is it. You can access these notes or just get back to the platform. Just get back to the platform for you to be able to do your studies. So that is it. That is all about the theory. What is remaining here for us is basically to do a question. So are we okay up to that point? 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 Okay, so having done that, I want us to move very fast. I want us to move very fast to a question. A question. Can you get a 5 minutes break before starting a question? Yes, let's meet at exactly 7. Let's meet at exactly 7. But I will be posting the question and the sitting here. So as you go for the break, please try to locate those particular questions. Try to locate the questions so that we do them very fast and mark the end of this particular topic. So our break starts right away. Great. So if you look at that particular question, it is basically putting what we discussed in theory to the practical application. Are we able now to execute the format so that we come up with the net profit as per marginal and as per absorption? So our question is from topic, from August 2022, question number 4, A and B. It is ATD, sitting. So if you read that particular question, you'll be able to see you are being told that RH Limited manufactures and sells a single product branded Z. Currently, it uses absorption costing to determine profits and inventory values. The budgeted production cost per unit is as follows: direct labor, direct material, fixed production overhead. Now, the cost given there per unit, the direct labor, the cost, so for you to interpret that, you're able to see direct labor, we have 3 hours at shillings 6 per hour. Is it? Now, if you look at the cost that's going to be incurred to produce 1 unit of this product Z, we have 18 shillings. So are you able to give us the total labor hours required? The total labor hours required to produce this particular unit. 3 hours is charged at shillings 6 per hour. Now, of course, they could have given you this 3 hours at shillings 6 per hour, then we have 18 shillings. So somebody will be confusing and checking this one here as the cost per unit. Or material, that is a direct labor cost per hour. Somebody will be confusing and checking this one here. This one here is the cost per hour. This one here is the cost per hour, but not cost per unit. 1 hour is equal to 6 shillings. But this particular product Z requires 3 hours. It needs 3 hours for you to produce 1 unit of Z. So please don't confuse the cost per hour with the cost per unit. because interpreting this will also be very, very important to you when you get to topic number 10, where you're going to deal with variances, the actual and the standard results. You have to understand this particular concept. The 6 shillings given here is per hour, but for you to produce 1 unit of Z, you need 3 hours, and therefore 3 multiplied by 6 is giving us 18 shillings. I believe that is clear to someone. Is that clear to someone? Is it clear to someone now? Okay, then we are given for the material, we are given direct material 4 kgs at shillings 7 per kg. So for you to produce 1 unit of Z, you need 4 kgs, but cost per kg is 7 shillings. So that's why you are taking 7 by 4 to give you 28 shillings. Then we have fixed production overheads. The fixed production overheads, it is fixed. But now if you use their normal standard, their normal capacity, when you divide by the expected units of output, you are getting that the fixed overheads is equivalent to 20 shillings per unit of Z. So if you are given the estimated output of Z, you can get the fixed overhead as per the normal standard or the set standards of that particular company. Additional information, normal output volume is 16,000 per year, and the volume is used to establish the fixed overhead absorption rate for each year. Let's listen to this. Overhead absorption rate, we say, is equivalent to budgeted overheads, taking us back to just the concluded topic, over total activity level. For this particular question, our budgeted overheads is the fixed production overheads, which we are being told that, remember, for you to get this, you take the budgeted overheads, divide by total activity level. Now, I want you to help me interpret what is going on. Do we have any of this within the question? Do we have overhead absorption rate? Do we have total activity level? Do we have budgeted fixed overheads? Please let me know what we are having. If you've seen any of these 3, just mention the name, then you type the amount. So I'm being told that activity level as per the budget is 16,000. Thank you. Any other item that you are seeing there? Any other item? Any other item that you're able to see? Do we have any? Because you cannot look for 2 unknowns. It means 2 of these items have been given to us. Budgeted production is 66. This one here is budgeted fixed overhead. Remember, your 66 has got direct material, direct labor, production, overhead. Thank you, Solomon. The overhead absorption rate has been given to us as 20 because it is per unit. Is it? Our activity level here is units, is it? So it means the overhead absorption rate will be shillings per unit. We've been given that the cost of producing 1 unit, direct labor, direct material, fixed production overhead, and it is 20. So it means this one here is the overhead absorption rate. If you have these 2 and your formula is here, are you able to get the unknown, which is budgeted overheads? Please go ahead and calculate for me this now. This is the unknown. This is what we are lacking. So go ahead and calculate it. Make budgeted overheads to be the subject of the formula. So budgeted fixed overheads is equivalent to overhead absorption rate. We multiply by activity level. If you do that, what will you have? We have 320. We have 320,000. So for the entire year, the fixed production overhead is budgeted as 320. But remember, it will only be 320,000 if the company produces and sells the budgeted activity level, which is 16,000 units. If they produce 16,000 units, then they sell the 16,000 units, they are going to operate at this level here. Their budgeted fixed overhead will be 320. Now a question to you. If you look at what we have there, there's a statement for sales and production. Do we have 16,000 units produced? Do we have 16,000 units produced anywhere? Do we have 16,000 units produced anywhere? Is it appearing anywhere apart from where we are told that the budgeted activity level is 16,000? Is it appearing anywhere? It is not appearing anywhere. So if it's not appearing anywhere, then we have to take care of the over or under absorption. We compare estimate, which is 320,000, with the actual overheads absorbed. Because it is 20 per unit, it is this one here per unit, but they have only produced 8,500 units. So 8,500 by 20 should give us 170,000. They're also telling us that this fixed production overheads was distributed equally throughout the year. So the first 6 months, you are going to have 160,000. So this is the actual that has been absorbed. The estimate is 160,000. The estimate as per their budget is 160,000, but here they have actually incurred. We have a total, okay, I've seen that. We've actually incurred 170,000 as the fixed production overhead. Their estimate, their budgeted estimate, if you divide it for the first 6 months, it is 160. So you ask yourself, they indicated that overheads is 160,000. The actual is 170. Is it under or overstatement? And how do we deal with that? How do we deal with that? So that's what we need to, again, identify. Time moving so fast, but I believe we are going to manage. So I want us to start with marginal. I want us to start with marginal costing. The marginal costing method, here we are being told, number 2, the costs relating to sales, distribution, and administrative are as follows. That is non-production cost. Remember the non-production cost, we have the variable component and the fixed. The variable is 20% of sales. The fixed is 180,000 per year. So it will be distributed equally throughout the year. So if you're going to deal with the first 3 months and the last 9 months, you just have to divide 180,000 for the first 3 and also for the last 9. If you're going to deal with the first 6 months, then of course you'll divide 180,000 equally. That is 90. Then the last part there were no units of finished goods inventory as at 1st of October 2021. The first 6 months of the period ending is 31st of March. So we have 31st of March. (2022). Then we have 30th September. Let me take it to this side here. Then we have 30th September. Now, 6 months. This is the end date of the first 6 months. And this is the end date of the last 6 months. So it means when we are being told that there was no opening inventory on 1st of October, the next day of the previous period. From here to here, we have 6 months, is it? Now count 6 months backwards. Count 6 months backwards. You're going to find that you'll be having 30th of September, but now 2021. So on this date, the closing of this date is the opening of 1st of September. Now, if this is the end of the period, the starting part of the period is supposed to be 1st of October, 2021. Here, there was no opening inventory. There was no closing or opening. There were no units of finished goods inventory as at first. So there is no opening. There is no opening inventory for the first 6 months. But for the last 6 months, the closing of this part will be the opening of this part. Are we together? Are these things really making sense? Are they making sense to someone? Are they making sense? Are we getting something really? Okay, now let's look at the question. Remember, for you to get the cost under marginal, it is direct material, direct labor, plus variable production overhead. So do we have the three? Do we have the three? Direct material, we've been given there that direct material per unit is 28. Direct labor cost per unit is 18. Then variable production overhead. Do we have any? Do we have any other variable production overhead here? Do we have any other variable production overhead here? So if you try to add these ones here, what will you have? 6. Do we have any other cost? Do we have any other cost apart from that? That is the variable production overhead. Do we have any? Do we have any variable production overhead? There is none. The only production overhead we are given is fixed. So remember we said the part of the cost of the product is variable production overheads under marginal costing. And that's what we are preparing here. So it means the cost per unit that is produced is supposed to be 46. Is it? As per marginal. So let's now go ahead. Let's go ahead and start preparing the statement. So the first thing that you're going to have here, if you're going to prepare your income statement, you must start with sales. You must start with sales. How are we going to deal with the sales? Look at what we have. The sales for the first 6 months, we have 7,000. The sales for the last 6 months, we have 8,000. Now, the selling price per unit, do we have it anywhere? The selling price per unit. Do we have the selling price per unit anywhere? Do we have the selling price per unit anywhere? Our selling price per unit is 140. So we have sales. 7,000. And then 8,000. Everything you multiply by 140. So what is the sales under this? The value of sales under the first 6 months. The value of sales under the first 6 months. People are not using their calculators. 140 by 7,000. 980. 980,000. About 140 by 8,000. What will we have here? 140 by 8, that is 11. That is what we have. Then we are being told, after having sales, you need to give us what we call cost of sales. And the cost of sales, that's where we are going to have our opening stock. Then we need to add purchases. Then we need to less closing stock. But remember, the items we are dealing with here are variable production costs. That is variable. Direct material is variable. Direct labor is variable. And there are only those two. We don't have variable production overhead. So it's only those two that will form part of product cost. So if you do that, because whatever we are dealing with is only variable cost, we'll be able to arrive at what we call gross contribution. So let's now go ahead and get the elements here. Opening stock. Opening stock. Additional information number 3 is telling us that opening stock for the first 6 months is 0. Opening stock for the first 6 months is 0. Then, how about production? Are you able to see the production in units? Not purchases. Here, we are producing, so add production. Are we able to see production? Production for the first 6 months in quantity, do we have it anywhere? Do we have production anywhere? We have 8,500. Then the last 6 months, our production is 7,000. Is it? Are we able to get closing stock? Here, for us to get units that have been sold, remember, opening stock, we are told is 0. You add production. We add production, which is 8,500. If you add all these, you're going to get what we call cost of goods available for sale, whereby the cost of goods available for sale, we are dealing with units, is 8,500. This is what is available for sale. Opening was 0. Whatever they produced is 8,500. This is what they have to sell. But are we able to get sales? Remember here, after getting cost of goods available for sale, you normally less closing stock. When you less closing stock, what will you get? You are going to get what you call sales. So can someone give us, here we have closing stock, which we do not know, but it happens that the examiner gave us the units that were sold, which is 7,000. So what is it that when you deduct from 8,500, you'll be able to get 7,000? What is it? When you deduct it from 8,500, you are getting 7,000. It is 1,500. So that is the closing. That is the closing. That is the closing for the first 6 months. That is the closing for the first 6 months. Can we clarify the opening stock? Opening stock tunaambiwa aje? Opening stock. The financial year here, let's say this is the financial year. It ends on 30th of the financial year. They have just decided to divide it into 6 months. And it is divided into 6 months. The first 6 and the last 6. But the financial year of this company is ending on 30th September 2022. When was it beginning? The beginning. So the beginning of this financial year, it is ending on 30th September. The beginning is the following day, which is going to be 1st of October of the previous year, which is 2021. So what happened on this date? What happened on this date? Have we been able to see something? Have we been able to see something? Then you relate to additional information number 3. Have we been able to see something now? Have you been able to see something and confirm? Have you been able to see something from this and? Is your question answered? Great. So having done that, let's now get to this point. We've identified that the closing stock of this part here is 1,500. Now, the opening of, somebody's asking me about the explain on closing. You normally say, you only sell what you have. Opening, you opened with 0. You added from the production department, you added 8,500. But now, how many units do we have that you can sell? You know, you only sell what you have. You started with 0, but you're able to produce 8,500. So the total goods that are available for sale, the goods that are available for sale are 8,500. But you managed to sell 7,000. What is your closing stock? What is your closing stock? What is your closing stock? Harriet, what is your closing stock? RN, what is your closing stock? Please let me know. Harriet, is it now explained? Is it now explained? Is your question answered? Great. So let's come back to this point. Remember, we are applying marginal costing. But the production cost, we said, it is only going to involve the production, the variable production costs. And the variable production cost happen to be direct material and direct labor only. We don't have variable production overheads. Now, can you go ahead and give me direct material and direct labor was giving us direct material we add 28. Direct labor we add 18. So what was the production cost under marginal? Production cost under marginal, it was 46. This 46, I want you to listen and even note it somewhere. This 46, it only applies to the production and closing stock. You cannot use 46 in valuing the opening stock. Remember, there are opening stock which was produced in the previous period. So we cannot say that 46 is going to be used to get the value of the opening stock. No, we only use this to get the value of the goods produced in that particular period and closing stock. So it means when we come to this part, we are going to have the goods that have been produced, then we multiply by 46. The closing stock that we have here, we are going to multiply by 46. So let's use the same method here. Yes, let's use the same method here for us to be able to get the closing stock of the last 6 months. So do we now have opening for September? Do we now have closing for this period? The first one here is 0. The second one, do we have it now? If yes, how many units? The closing of the first 6 months is the opening for the last 6 months. So opening is not going to be 0 again. It will be 1,500. It will be 1,500. And let me confirm if you're able to see my board. Let me just confirm if you're able to see my board. I believe it is visible. I believe the board is visible. Okay, we have 1,500. How about the goods that have been added, which is you can add through production or purchase, but we've now produced. So if you look at the production, for the first 6 months, it is 8,500. For the last 6 months, it is 7,000. So I will need to add 7,000 for me to get goods available for sale, 8,500. Goods available for sale is 8,500. But how many units did these people sell in? How many goods were sold for the last 6 months? How many? How many were sold for the last 6 months? 8,000. Is it? We now bring those ones that were sold. I added 8,500. I've sold 8,000. The balance is what I call closing stock. Give me the figure here. My closing stock in units. My closing stock in units, we should put it here. My closing stock in units. My closing stock in units. Opening, the first 6 months, the last 6. Opening stock, you add 0. Then production, you add 8,500. The goods that you have, which you can sell, is 8,500. But you sold 7,000. Whatever is remaining is the closing, which we've said is 1,500. Closing for this period is the opening for this other period. You manage to produce 7,000 for the last 6 months. What you now have, which you can sell, is 8,500, but you sold 8,000. Whatever is remaining is what we call the closing stock, which is this one here. Is it now clear? Is it now clear to everyone? Is it now clear to everyone? So our closing or opening here is 0, then 1,500. Great. Now let's now go ahead very fast and calculate. So I want to get for this part here. First of all, opening is 0. So that 0 will remain. Let me put them here and here. Okay, of course, here we are going to have opening. Production, I want to take 8,500 by 46. What do you have? 8,500 by 46? 8,500 by 46? 391. So I'm going to have 391. 391,000. Good. 391, I need to less closing stock, which is 1,500 by 46. 1,500 by 46, 69. So I've known the value of closing stock. Remember, it is this closing stock that I'm transferring to be the opening, the 1,500. This one here, in most cases, if it is there, the examiner will give you the units and the cost per unit, or just give you the value and the units. Here, this one here, we are forgetting about, but the 1,500 is the same one. Is the same one here. So this 1,500, we multiplied by 46 to get 69. It means our opening here will be the same amount. But now with a different name. Here, if it is closing, we are going to deduct it. If it is opening, we add it. Then we come here, we come to this part. So we want to get the cost of goods, which we are going to sell. It is opening, add by production, less closing. So what is the cost of goods? What is the cost of goods? 391 minus 69, 322. 322 is the cost of this good. So remember, whatever you are dealing with, the 46, it is direct material, direct labor, and then variable production overheads. So we are only dealing with variable costs. That's why we indicate gross contribution. Can somebody give me the gross contribution? This minus this. Gross contribution. Gross contribution, 658,000. 658,000. Great. 658,000. Then I now come to which part? Here. Let's go to this other side now. I have opening, I add production. My production is 7,000 by 46. What do I have here? 7,000 by 46. 7,000 by 46. 322. Then I less closing stock. Closing stock is 500 by 46. 500 by 46, I'm told this 23, but I need to less. If I do that, I need to get the cost of these goods here. Cost of the goods, 69 plus 322, 69 plus 322, less 23. 300, 500, no, you are lying to me. You are lying to me. You are lying to me. 368,000, 368,000. What do you have as the gross contribution? What do you have as the gross contribution? What do you have as the gross contribution? 752,000, is it? Now, after getting 752,000, this one here is basically the variable production cost. You now come here and less, or just indicate variable non-production costs. So the variable non-production costs, we have selling or administration, we call it sales, admin, and distribution costs. What are they telling us about these costs? What are they telling us about these costs? Additional information number 2. What are they telling us about the variable sales, distribution, and administration costs? The variable, it is what? 20% of sales, is it? So can you go ahead and give me the 20% of sales here? 20% of sales, 20% of sales here is 20% of sales. 20% of sales for the first one, 20% of 980, 20% of 980, 196,000. Remember, it is an expense. We are going to less it, of course. How about this one here? 20% of the sales. 20% of sales up here to 24,000. When you take gross contribution less variable non-production cost, whatever you are getting is what we call net contribution. So go ahead and give us net contribution. Go ahead and give us net contribution. Net contribution. Net contribution, this minus this, the first one. The first one. Is it 212? Is it 212 or something? Okay, 462,000. How about this? Net contribution, 528. After getting the net contribution, you now go ahead and less the fixed costs. Less fixed costs. So the fixed cost here, we have one. We have fixed production. Fixed production cost. Remember, the fixed production costs were not part of the product cost, so they have been brought here. Then we also have fixed non-production, which is the fixed sales, fixed admin, and distribution. So we can just call it fixed non-production costs. Look at the statement. The fixed non-production cost is 180,000 per year. But we have divided the year into two, into the first 6 months and the last 6 months. But look at this statement here. Look at this statement here. Look at this statement here. Where is it? Number 3, there were no units of finished goods inventory as at 1st of October 2021. The fixed overhead expenditure is spread evenly throughout the year. The fixed overhead, both fixed production and fixed non-production, they are distributed equally throughout the year. So if 180,000 was for the entire year, then the fixed non-production, this one here will be 90,000. This other one will be 90,000. How about the fixed production cost? How about the fixed production cost? How about the fixed production cost now? The fixed production cost, we were told that it is 20 per unit. It is 20 shillings per unit. But the estimated units of output is 16,000 units. So by 20 is supposed to give us 320,000. This 320,000 is for the entire year. So we need to divide this by 2 because the months are equal. The first 6, the last 6, and they are distributed equally. So we need to have here 160,000. We need to have 160. We need to have 160,000. So by doing that, you just now come and give us the net profit. You come and give us the net. You come and give us the net profit. So that is it. That is what you need to do to give us the net profit. So give me the net profit here and this other side. Of course, these are expenses you deduct. Those are expenses we deduct. So here I'm told it is 212. How about this other side? I'm told this is 212. How about this? $278. $278,000. The fixed production costs are being taken as an expense. They do not form part of the product cost. They do not form part of the product cost. So that is it. That's what we're supposed to do under marginal costing. As we've seen, the production cost is 46 under marginal. The production cost is 46, and the production cost is what we use to value the closing inventory, because closing inventory is part of the goods that were produced. Of course, if you move to advanced level, you'll be told that this closing inventory should be determined by using the FIFO and LIFO method. Again, if you're going to value your inventory, which I believe we covered extensively. So having done that, you want to do the same thing. You want to do the same thing, but now using absorption costing. Absorption or full costing method. Absorption or full costing method. Full costing stroke absorption. Full costing stroke absorption method. Number 1, we are going to have 31st March 2022, 30th September 2022. There are some things that are not going to change. 1, if you come to sales here, you are able to see that the units which were sold, we add 7,000, we add 8,000, and their selling price was 140. That one does not change irrespective of the method. So if you have 140 there, It means this one here is going to be 980,000. This one here will be 11. That one does not change. That one does not change. Then we come now to cost of sales. For the cost of sales, we have opening. We need to add production. We need to less closing stock. Opening for the first one was 0. This one here was 1,500. Production, we add 8,500 and then 7,000. What we are lacking is the value per unit. Closing, we add 1,500 for the first one, and the other one we add 500. What we are lacking is the cost there. Okay, having done that, we'll be able to get an adjusted profit. So I believe you are calculating these figures. So give me this one here. Now, for us to get the cost under absorption or full costing, it is direct material, direct labor, variable production overhead if it is there, then fixed production overhead. But per unit, direct material per unit were given 28. Direct labor, you were given 18. Variable production overhead was not there. And fixed production overhead per unit, what were we given? It is 20 per unit. Now, when you add everything, what do you have? It is the production cost. What will we have? 66. So that's what you're going to use for the production and also for the closing. So go ahead and give me the figures. So this one, of course, is just the closing transfer to the opening. So what do we have? 8,500 by 66. 8,500 by 66. What do we have? 561. So here, let me put it here. Of course, opening is 0. Then about, I can even also take this one together, but let's deal with the first one. Then I also have 1,500 by 66. What will I have here? 1,500 by 66, 99,000. But of course, I need to less that for me to be able to get cost of the goods that were sold. So the cost is this minus this. What do we have here? 561 minus 99. 561 minus 99. What do we have? 462. When you less, you get unadjusted profit. So let's get the profit here. The profit, 518. It is 518. Let's come to this other one. So the closing of 1,500, which is 99,000, is the opening here. It's the opening of 99,000. Then we add production, which is 7,000 by 66. 7,000 by 66 for 62. Then I need to less closing, which is 1,500 by 66. I mean 500 by 66. 33,000. When you less that, you get cost of sales. So cost of sales, 99,462 less 33. What will we have? What will we have there? 528. 528, when you less, you should be able to get an adjusted profit. An adjusted profit, 592. 592. So we need to adjust our profit. We need to adjust our profit. Look at what we have done here. Remember the overhead absorption rate which was given was 20 shillings per unit produced. Is it? Per unit produced. Here, but they have a target of 16,000 units. That was their budget. Here, if you do that, you're going to have 320,000. If you get now the budgeted overheads, when you divide it equally, you're going to have the first six will be 160,000. Here will be 160,000. That's as per the budget. Now the actual, they have managed to produce 8,500 units. 8,500 units by the rate, which is 20. By the rate here, which is 20, will give us 170,000. The other one, for the last 6 months, they have managed to produce 7,000 at the same rate, which is 140,000. Tell us whether we have over stroke under absorption. So we need to deal with over stroke under absorption of overheads. Over or under absorption of overheads. Tell us, is it over or under here? Is it over or under? Their estimate is 160. They estimated as 160. The actual is 170. So they understated the expenses by 10,000. Is it? If you understate expense by 10,000, what are you going to do to that 10,000 to make sure that you have the right profit? Here, so we have 10,000. We have the difference here is 20,000. What are you going to do to 10? What will we do to 20? The actual one is this. The actual one is 170. So what do we do to make the expenses appear the way they should be? And remember that is affecting our profit. If I stated 160, but the real expense is 170. So expense was reduced. When I reduced expense, profit was exaggerated. Is it? Profit was exaggerated. So how do I deal with the two? I have 10,000 there, and then I have 20,000 here. What do I do? What do I do? What am I going to do? What am I going to do? So here, when I understated, profit was exaggerated, is it? So I need to reduce. Profit was exaggerated. It was exaggerated, is it? So what am I going to do to make it to the real one now? What are we going to do? Add 20, less 10, add 10, less 20. Let's see those who are getting it correctly. Let's see. Let's see those who are getting it correctly. So the 10,000, the real one is 170, but we stated 60. So what do? We add the 10,000. The actual is 140, but we indicated 160. So we less. So if that is done, the profit you are going to get is called adjusted. Adjusted profit, which will be 528,000, which will be 572,000. Yes, don't worry, we're just done. We're just done. So whatever is remaining here after doing the adjustment is to give us the variable non-production, then the fixed non-production. The variable non-production, this one was 196,000 to 24,000. This one was 90,000. When you less, you should be able to get net profit so that we meet. Mtu ashapotea. Okay, so let's just end the session. You just get the differences here. Just get these ones here. Then when we meet on Tuesday, we'll be able to reconcile. I want you to get the profits as we live. 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 Somebody. The first 6 months, what are we getting? The first 6 months, 528. So you're going to have 242. As you can see, it is different from the other one. And then this one here, we have 572 less 224 less 90. We have 258. So next, in our next class, we are going to reconcile this so that either we have, I think here we had a 212.